Hello everyone, welcome back. My name is Arias, and today we're going to be breaking down an excellent interview by Dave Lee with Tim Bixby, the CFO of Lemonade. Lemonade is one of my larger positions, and this interview is extremely insightful in understanding the company a bit better. It was a 2-hour-long interview, so I've tried to pull out just the most interesting and insightful portions and given some thought where I could add value. This is a new type of video for me, so let me know what you think in the comments below. I also left the timestamps for each clip if you want to look into them more. Don't forget to like and subscribe for more Lemonade content. And without further ado, let's get into it. In this clip, Dave asked Tim about the breakdown of what types of policies they write. Tim first recognizes that by customer count, yes, the majority are renters, but then he said this.
So today, even though more than 90% of our customers are renters, something like 30% or more of the new dollar premium coming in is coming from homeowners. And that's been a gradual shift. 3 years ago, that number was about 5%. Now it's more like 30%. So over time, we'll start to see our customer base and our product breakdown look more like the market. And in the US market, it's something like 90% of the dollars come from homeowners. For us, that's less than 30% today, but that's been shifting fairly rapidly over the past 2 years.
What I thought was interesting about this shift was the speed that they are moving towards homeowners policies and how much room they have left to grow. They're at 30% of their premium dollars currently coming from homeowners, and Tim estimates that this will trend towards 90% over time. Let's try to estimate how this shift could affect Lemonade's long-term average revenue per customer. Homeowners policies are much more expensive than the more common renters policies, with Lemonade's starting price 5 times higher at $25 a month instead of $5 a month. Later in the interview, Tim said that the average price of a renter's policy is between $160 and $170 per year. So if we split the difference at $165 and take the monthly cost at about $13.75, this is 2.75 times more expensive than the starting price of $5. Now, the starting price of a homeowner's policy is $25, and if we apply the 2.75 multiplier we got when analyzing the renter's policy, and then multiply it by 12 months, we'll get $825 per year for a homeowner's policy. This shows us how much upside is left in the customers that they have already acquired and who will naturally move towards homeowners policies from the renters policies that they have now. In this clip, Dave asked about the advantages of starting by attacking renters insurance for Lemonade. Take a listen.
Which is because of the cost of the infrastructure of a larger incumbent insurance provider, it wasn't uncommon to have minimum prices. So whether your risk of loss and insurance, that's really what we're protecting against, right? You or I have a risk of loss. And at the lower value points, if you're a renter, you don't have many belongings, and therefore you need less coverage, you're below the cost to serve of many large insurance players. Whether you're $60 a year, $160 a year, or $360 a year, those are all relatively low value points. And so for Lemonade, because our cost to serve, we believe, is less. We know it's less. We have no agent infrastructure. We're not paying commissions to bring in new business. Our efficiency, if you think about how many employees we have per customer or per dollar of premium, those are all very efficient for our business, even at our relatively low scale. And so what we were able to do is price under those minimums. We don't have a minimum. Our minimum is really to cover the loss of the customer, which is really the core of the insurance product. It's not to cover overhead or fixed costs or commissions.
Here, Tim speaks to the flexibility of Lemonade due to their digital infrastructure. Lemonade runs their business so much more efficiently than their legacy competitors that they can profitably acquire and serve customers that traditional incumbents aren't willing to or able to serve profitably. This illuminates one of Lemonade's main advantages. They are lean and nimble enough that incumbents can't compete with them on price in some areas. Once they acquire a customer due to their low price, Lemonade gets a chance to delight the customers, as they like to say, with a great experience and earn their future business as they need more coverage and expanded coverage types throughout their life. Here, Dave asks if Lemonade was seeing slowing growth in the renters market, and the short answer is
no, actually we have not.
He did talk about how their business is broadening out as the profile is changing, so instead of in the beginning just acquiring renters for $60 per year, they can now acquire homeowners who pay up to $6,000 per year. This lends itself to increased flexibility in their business, which drives efficiencies in all sorts of ways. Here, Tim is asked about the total addressable market for renters insurance, and he covers their total addressable market for other types of insurance as well.
I would think of it in, again, annual premium, because that's where you can get a pretty good approximation of the market. And that number is in the $3 or $4 billion range. So for us, just over $200 million, less, some subset of that is renters. is a pretty small proportion of that. The homeowners proportion is something just south of 100 billion in the U.S. If you were to add in Europe, we're now in Europe as we have been for a couple of years. That would double that addressable market. So 100 billion goes to 200 billion plus, and that's just in the homeowners renters portion of the market. On top, pet is an additional market, life insurance additional, and then there's other types of insurance beyond that.
Tim said that the renters market in the U.S. is in the $3 to $4 billion range in annual premium, and also that Lemonade is just scratching the surface of that market, as they finished last year with an annual run rate of about $200 million in premium. By my math, only about 65% of that is renters, and so they are just scratching the surface of the renters market, which is dwarfed by the housing insurance market in the U.S., which is valued at $100 billion per year in annual premium. The market size is about double that if you include Europe, which they're already expanding into. As you can see, this is a giant market that they are playing in, and that doesn't even include life or pet insurance, which they have already launched, or other types of insurance that are certainly coming, like auto insurance. This is another pillar of my investment thesis in Lemonade. They are going after a huge addressable market that will give them a chance to be a giant company going forward, even if they do not capture dominant market share.
Mm-hmm. Interesting. If it's a $3 to $4 billion renters insurance market in the U.S., then I guess if you had something at $100 average premium, that would be 30 to 40 million customers, right? At a $200 per year average premium, that would be about 20 million. Am I off, or is that generally the ballpark, you think, in terms of customers?
I would think of there's a couple things going on there. So in terms of our price point, our average is in the under $200 range for renters only. So 160, 170 moves around, but I think of that range. The average renter in the U.S. overall is higher than that, probably $200 plus. And then there's uninsured renters in the U.S. So remember, something like 90% of our customers are first-time buyers of insurance. And so there's the established renter market, which is the $3 to $4 billion market. There's the uninsured renters market, and we're getting more than zero of those. It's hard to pinpoint, exactly which type of customer you're getting, but the uninsured renters market roughly doubles that size. So it's important to take that piece into account as well.
Let's start by doing the math Dave was trying to do to determine the total addressable market size for renters insurance in the U.S. If we use the average renters customer that Tim quoted us of $200 per year and the total market size that he gave us a few clips back of $3 to $4 billion, we get a total addressable market for Lemonade of 17.5 million potential renters in the U.S. Tim then said that the market may double if you include uninsured renters in the U.S., and that Lemonade is getting some of these customers from uninsurance. This shows us how much further Lemonade may have to grow, only having 1 million total customers, which include homeowners, renters, and their other insurance products at the end of 2020, but still a potential 35 million to acquire just in the renters market alone, which is smaller than the homeowners market. If I didn't say it before, they're going after a huge market and they're in the early stages of this growth. In this clip, Dave takes on a very important question, which was their slowing customer growth in Q4, when they showed only 6% quarter-over-quarter growth. Let's take a listen.
Yeah, I would think of it this way. So we're not optimizing for customer count. We're optimizing for premium. So, and that's really what you saw is because we have the ability to optimize across the portfolio, we'll go where the benefit is. And so we're able to generate more premium from a smaller number of customers. We'll go that direction. We'll deploy that capital in a way where we're acquiring profitable customers and maximizing within other parameters. I'll talk about those a bit, the in-force premium that's in place. And because we now have the opportunity across multiple product types to do that, you'll see these aberrations. You'll see these quarterly fluctuations in customer count growth. So Q4, while the Q4 result was a somewhat lower than the historical quarter pace, I would view that as an aberration, more as a trend line. And again, because we're optimizing for in-force premium, the customer count is more an output versus an input.
He goes on to say if they were a renters-only company, changes in customer growth rate would be more meaningful. But since they can add customers in all sorts of insurance types, it does not mean much. For example, if they could acquire a homeowner customer that it comes with 10x the premium for a smaller cost of acquisition than a renter's customer, it of course is a much better use of capital to acquire the homeowner rather than the renter. Most of this was reiterating what was said on the conference call, but the other important thing here was that he views this slower customer growth as more of an aberration rather than a trend, trend. And this is comforting going forward because Lemonade does need massive growth going forward in their market to justify this investment.
No, it was not a sudden change. It's always been the primary focus. What has changed, though, is our product offerings have changed. We have, by design, increased the proportion of business that we're comfortable taking, that is homeowners, for example. We used to have an upper limit on homeowners' value of $500,000. Above that, we wouldn't write the business. In fact, there was a time where we were turning down 2/3 of the business that was coming to us out of just caution. Let's build the business in a methodical way.
Tim's response here is very interesting for two reasons. First, it indicates that as long as the top line continues to grow, that they are executing on their plan. I'm not yet sure if I agree with this plan totally, because I think their AI may not be appreciating enough the potential to keep these cheap renters customers for a lifetime of insurance needs. If you think about it, Lemonade has only been around for 4 years, and therefore can't directly see the benefits of all that much of their land and grow strategy with customers. This is both because of the time constraints and because they have been primarily a renters and homeowners business during this time, so the AI may not yet be able to see the full potential of cross-selling insurances that they have added recently, and is definitely not seeing the insurances that they are going to add down the line. This points to the possibility of accelerating customer growth as a trend a few years in the future, once the AI that they use to run their ads is able to see the full potential. The other interesting thing said here was about Lemonade turning away 2/3 of their business coming to them out of caution in the early days. This is a crazy stat and makes me think that Lemonade has been winning the new insurance game while tying one of their own arms behind their back. Now that they aren't turning away the most valuable homeowners policies, this type of insurance will continue to grow as a proportion of customers and dollars to Lemonade. In this next clip, Dave asks an excellent question about how their overall land cheap renters and expand their coverage strategy is in tension with their optimization for IFP. Tim first points out that they've grown at an accelerated rate and still maintained an acceptable loss ratio, but then says,
to your specific question, I think the tension the tension versus the complementary aspect is we can do both. We can walk and chew gum at the same time, as we like to say. Our renter base, by definition, will age. They'll season. They'll get a little older. They'll get a little wealthier. They'll start to buy condos or homes. They'll have larger families, and we'll grow with them. And if we keep them happy and our net promoter score is high, we'll retain them, and they grow over time. And we've shared some statistics that show that is absolutely happening. But at the same time, most of the business that we're adding, most of the growth in premium is coming from new customers whose first purchase is a homeowner's policy or a condo owner's policy or now a pet policy or a life policy. Now, many of those folks are also buying a second policy. And so we're checking a couple of important boxes here. But the vast majority of our growth is coming from new customers. So monetizing existing customers is not a primary focus of growth. It's a thing that naturally happens. And this is one of the nice side benefits of acquiring customers young, creating a really engaging and delightful customer experience, enables those customers as they grow to be happy staying with us and driving that growth where we don't really do much, number one, or pay much really at all for that incremental growth. But our primary focus is to acquire new customers that we can then cross-sell additional product types and fill out the broader portfolio of each of the different coverage types, including the newer ones that we've launched more recently.
Mm-hmm. This is interesting because he outright says that they are not focused on creating this long-term tailwind of having lots of young customers, and that they are fully committed to adding customers that bring the most premium today for the cheapest and most capital-efficient cost. I have to say, I hope they have a bit more focus on the long-term IFP growth than they are letting on, because I am not a fan of just being interested in adding IFP now while sacrificing long-term growth. However, I do think that they have this focus, and that will be revealed further as this interview goes on. In this clip, Dave asks about how Lemonade is attacking homeowners insurance and how they plan to stand out there, as it is much more competitive than renters. Tim starts out talking about how Lemonade aims to stand out with their customer experience, which is central to the appeal of their company, but then move on to the advantages that only they can provide through their digitally native infrastructure. He gave one stat that floored me. Let's listen.
But relative to the typical experience in the market today, more than 90% of policies in the US are still sold through an agent. And through an agent, almost by definition, means you don't start and finish in the same few minutes. It could be a half an hour, it could be a day, it could be a week, but there's usually a process to go through. And so we're able to take people through start to finish in a matter of minutes, in what ends up to be a pretty surprisingly pleasant experience.
Greater than 90% of homeowners policies in the US are still sold through an agent, and as Heath pointed out, this experience is inherently less convenient for consumers. This shows us that there is a huge online shift that is really yet to come in insurance, in earnest, because in my opinion, no one will want to go and get a policy in person in 20 years from now. Now maybe I'm just a weird kid, but if you gave me the option to sign up on my phone or laptop without having to talk to someone in minutes, versus having to go to a physical location and talk to someone and get an answer back hours or days later, I will, and many of those in my generation will, go online every single time. I was under the impression that this shift had already really begun and taken hold, and that maybe half of the policies were written online already, but I was wrong. This puts Lemonade in an even better position than I had previously thought, because they have already set up and optimized their infrastructure for the digital age, something that the legacy brokers are yet to do, and I think this gives Lemonade an excellent opportunity to capture market share going forward. In this clip, Dave asked specifically how Lemonade is planning to compete in the homeowners insurance market, where they do not lead with price as much as they do in renters, and I think this snip sums up Tim's thoughts pretty well.
And we didn't want to compete in the same game as others are already competing. We wanted to compete with a 10 times better experience with without price being a factor. And if we can be a little bit less or well less than others, great. But even if we're on par and it's a 10x better experience of efficiency and customer delight, that's a win for us.
I thought this was interesting, that they're not planning to price their products significantly lower, and that they're still expecting to capture market share. I think this strategy will work, as their fully digital customer experience is significantly better than incumbents, in my view. This, combined with the fact that Lemonade's digital infrastructure is at lower costs than competitors, it points to Lemonade being able to be more profitable than others on the same policies, which is obviously very good for their future prospects. In this clip, Tim was talking about their decision to launch pet insurance back in July, and there was one really strong indicator that came from this.
And then the last piece that was really interesting as well was something like 5 or more % of the new pet policy owners then bought a second policy.
I think this 5 or 6% cross-selling rate is just how well Lemonade's machine is working. Just imagine the increase in the lifetime value when someone buys a second policy with no additional customer acquisition cost. Each new product that they launch, and they are launching more products at an accelerated rate now, serves as a new way to acquire customers for their other policies by getting customers in the pipeline. This is an incredibly strong portion of Lemonade's business, and as I watch this story play out, I'm excited to see it grow. Here, Dave asked about the rollout of life insurance and their choice to do it with a third party instead of on their own.
So life insurance is interesting. The front end, the customer decision process is much like other insurance decision processes. Can be a little annoying, can be cumbersome. There's lots of questions. There's process. There's doctor exams, and so we felt there was a real opportunity for us to lemonadize all of that. And the product we ultimately were able to launch truly does that. It's minutes. Rather than hours or days or weeks, to be bound with a life insurance policy, not a quote, but a life insurance policy.
While Tim's comments about how they plan to compete in life insurance are revealing as to why someone would choose Lemonade for life insurance, I see these comments as also indicative of something else for future products in the long term. Lemonade only looks to launch products where they feel they have a differentiated offering. I think this explains a bit of why they have waited 4 years to launch auto insurance, and that may be because it's more difficult to differentiate in this area of insurance. With 90% plus of homeowners insurance policies still being done through an agent, Lemonade can make a much larger difference with just an improved experience of getting a policy quickly and online. With auto insurance, quickly and online is the norm, so they have waited to make certain this product offering will stand out. One of the ways they may do this is by tapping into the telemetry of the car, and Tim refers to this later, or by charging per mile trip. However they do it, I'm sure Lemonade will make sure their product stands out when it is launched. In these next two clips, Tim is talking about the advantages of the commission structure they chose to use when entering life insurance. Let's take a listen.
The economics are pretty much the same. So it's sort of a win-win. We don't give up much at all from a customer relationship or a customer experience standpoint, and we don't give up much at all from an economic standpoint, because for each policy that we sell, we are earning a commission back from the provider that looks very much like the contribution we might get from a customer if we wrote the policy ourselves. Now, we're not married to this forever. We love our partner. We think they're great. We'll learn and grow with them. We'll see how things go. But we have the opportunity over time, if it doesn't work well or we think we did something wrong, to fix it and change it. I don't expect that to happen, but we always have that option because we built the platform with these transitions in mind.
The first bit of information there is that Lemonade managed to get a commission structure that is favorable enough to them that is similar to what they might expect to earn if they were willing to write the policy themselves. This almost makes it a no-brainer to go with commission structure in my opinion. He also reiterated Lemonade's flexibility, which seems to be a core value of their company due to their digital structure. Just like reinsurance, which Lemonade will only use if it is beneficial to them, Lemonade will only use this commission structure as long as it's beneficial to them, and for the foreseeable future it will be. However, their partner is making a profit as well, no doubt, so as Lemonade matures and has more capital available to them, I would expect them to move to writing their own policies at some point, maybe in a decade or two. In this clip, Dave asks how Lemonade plans to stand out when launching insurance products in more competitive markets, like specifically auto insurance. Tim first reiterates that Lemonade will only launch a product with a differentiated experience, and then shared some thoughts on bundling.
Bundling is important, and I should be clear to say that bundling, in my view, doesn't equal discounts. Bundling often does mean discounts, meaning there's added value to have multiple policy types. Good things happen when people have more coverage with one vendor. They tend to be, in some cases, more responsible. They tend to have longer lifetimes with the company, more greater retention, more loyalty.
What's interesting about this is two things. First, that bundling does not mean discounts for Lemonade, meaning that they think that the bundling and the simplification alone to the consumer will be enough to entice customers to use Lemonade insurance for all of their needs. Second was the point that bundling typically improved lifetime value and retention, and sometimes even loss ratio overall for customers. In this way, Lemonade's current success is quite remarkable because they have achieved excellent lifetime value to customer acquisition costs and an excellent loss ratio without the benefits that come with bundling. This is the next unlock for Lemonade and will power their growth as we move through this decade. In this next clip, Tim is talking about Lemonade's advantages when it comes to data, and he inadvertently spills the beans, I think, on Lemonade's plans for the entrance to the auto market. Let's listen.
Two, data is critical. We believe that we've gone from a data disadvantage to a data advantage in the businesses that we're already in. We collect a lot of data per customer. We leverage that data in a lot of very thoughtful and also economic ways. Your example of car insurance is very data intensive in a good way, meaning there's quite a bit of data to collect and leverage. There's new technologies that are being adapted and used. Telematics, we think, is a really important driver in how to bring a better experience.
First of all, we know that Lemonade is collecting and using data very effectively, as evidenced by their loss ratio. The interesting thing here, though, is that Tim lets it out that he thinks telematics are very important to providing a differentiated experience in auto insurance. So clearly that's what they're working on, if they are indeed working on auto insurance. He also talked about other kinds of data, and I think that might include allowing your phone to track your driving and maybe charge you by the mile. Metromile, another insurtech company, has taken this approach and has drastically lowered costs, and Lemonade is definitely aware of their success and may take a lead from their product. In this clip, Dave asked Tim about how they collect 1,700 data points in a quick sign-up session with the customer.
But the most valuable part is that 100% of our customers go through the same process using the same system, and we collect the same depth of data for all of them. So we're not only getting a deeper view of each individual customer, we're getting a deeper view of the customer base because the data is consistent across every customer at great depth. And what's interesting is, in the 1,700 data points, there's not only the data that we know we want to collect and react to and think about and analyze and draw conclusions from, there's also the data that we don't know why it's interesting or important. We just know it turns out to be, using AI, interesting and important for everything we do.
This is the magic of Lemonade's integrated digital platform at work. They collect every piece of data in the same way from all of their customers and let their AI engineers experiment with it until they find how to best optimize it and use it. This is where Lemonade really excels from the legacy players and really makes their lead in use of AI tough to compete with, because to truly compete with Lemonade, they need to cut out the brokers, which is currently how they sell much of their policies. Lemonade is disintermediating that and going direct to consumer with insurance, and then taking the full advantage of this platform and using AI to run a better business. For this next clip, Dave asked Tim how Lemonade is able to collect and use so much data with such a quick sign-up process. Let's listen.
So we have one system that does everything that our business does and has visibility to everyone in our business that needs to have visibility. And so what that means is we are seeing a potential customer turn into a customer, quoting, binding, customer support, customer inquiry, payment, non-payment, claims management, risk profile, all of that is happening in our company in one system, built from scratch by one team in the last 3 years on the latest technology. So everything that's happening that's interesting is not only interesting, but it's available and leverageable in real time to all the people who need to know. And so our ability to react to something that happened yesterday, today, and take an action that has impact tomorrow is extraordinary. To us, it's just normal. We upload code, and basically, which means we basically change our product, make small improvements and modifications to our product that affect customers, not always visible to the customers. We do that 20 times a day.
Tim starts off by talking about how Lemonade's integrated system gets all the data and information to all of the places it needs to be throughout the company. And so while Lemonade may not have nearly as many customers as a huge incumbent insurer, they are collecting more data every time they get a new sign-up, roughly 1,700 data points versus 30 to 40 through the broker-based model. And they're getting all of this data in a uniform way through their platform that is consistent every time, which is in stark contrast to the incumbents that not only collect their data from brokers, who may do everything a little bit differently, but they also have to use siloed old systems that still run on COBOL. The usefulness of this data is then multiplied as it is shared throughout the company and results in improvements to the product a staggering 20 times a day. This is a crazy rate of iteration and innovation, and I personally want to bet on companies like this that are adapting and moving fast. In this next clip, Tim talks about new data opportunities that are opening due to Lemonade's increased cross-selling.
We're collecting and storing this data. Not all of it is helpful and useful yet, but as we expand our coverage types, we're finding things we didn't know we now know. So I've got a customer base. Now I know a little bit more about what does their behavior around pets and pet health mean for a renter or a homeowner. Didn't have that 6 months ago. Now I have that. Now we're going to start to learn what is the life insurance buying and thinking process? What does that mean to the rest of our business?
Lemonade is only going to get more efficient with their use of data as they are able to collect data on more interactions as users go through multiple sign-up processes as they buy multiple products. Now here's where data will be especially important, and this requires a little conjecture on my end, but I think Lemonade will look at this data and find new cohorts of customers to advertise to and still keep their lifetime value to customer acquisition cost ratio in range with where they want it to be. For example, these new customers may not look like great renters or pet customers on their own from what they have previously seen, but they may find that with data coming in from both of these new customer acquisition channels, that a new group of customers is attractive for Lemonade to acquire. These synergies will allow Lemonade to grow faster and longer than otherwise expected. This clip is for those ARK Invest, who are worried about their reinsurance structure.
Reinsurance doesn't really tie our hands. We have the ability to do the things that we need to do and want to do to create a great customer experience. It almost never comes into play. It's essentially invisible from a customer viewpoint.
There you have it. Point blank, reinsurance does not tie their hands in any way. He goes on to saying that they do have to maintain a reasonable loss ratio to keep a good relationship with their reinsurers, but Lemonade will be looking to keep their loss ratio in this range to run a sound business. But I thought this was important for the skeptics of reinsurance. These next couple clips are back and forth with Dave and Tim drilling down into the specifics of the reinsurance structure. Some of the clips are a bit longer, but bear with me. I think they really simplify a topic that is not explained extraordinarily well in any other company documentation.
Let's say we have $100 of premium collected, hypothetically.
Yep.
So off the top, it seems like about 2.5% or $2.50 of that will go to some type of blanket catastrophic kind of insurance.
The one that you're describing, which is a specific type of catastrophic coverage, is if the amount of loss in any one instance or any one location is significant, like over $500,000, for example, there would be coverage that would kick in that we would not be liable for.
Here, they're talking about catastrophic insurance for any single instance, and this sounds like it would cover Lemonade. For example, if $1 million house burnt down, Lemonade would only be responsible for the first $500,000, and then everything else will be covered by the catastrophic insurance. I think this structure is very smart as it caps their downside risk significantly, and also probably makes them a more capital-light business.
The rest, so $97.50 or around there, you take that premium, and then 25% of that, so let's say about $24 or so, Lemonade keeps, and they're paying 25% of the claims or of the claim liability, I guess, from that 25%. So about $24 in total premium, and after they're paying, I guess your share of 25% of the claims, the rest is kept as gross profit for operating expenses. Is that kind of generally the sense of that 25% that you guys keep initially? And then you give 75% of that $97.50 to reinsurers, but then the reinsurance companies, they give you 25% of commission. On Lemonade side, you combine the $18 of commission from the reinsurers or so, and then you combine that with the leftover money from that 25% that you guys kept after paying, your claims liabilities, maybe $8 or so. So you guys are left with maybe $25 or so of gross profit, which then you guys use to pay operating expenses.
Whether a dollar of premium is kept by us, retained by Lemonade, which is the 25%, or if it's ceded or given to the reinsurance partners, which is the 75%, either way, it's about the same economic impact on Lemonade. And your example, I think, was right on.
In these 3 clips, they drill it down into the heart of Lemonade's reinsurance structure. I've made a flowchart to recap and simplify even more. We start with $100 in premium, and for the sake of simplicity of this flowchart, we'll ignore the 2.5% catastrophic insurance. 25% of the $100 Lemonade will keep, and then they will cede the remaining 75% to reinsurers. The reinsurers pay Lemonade 25% commission on the premium they receive, which works out to about $18 of the $75 they received. That leaves them with about $56 of the starting $100, but they are responsible proportionally to the amount of premium that was first ceded, meaning that they are required to pay 75% of each claim. Lemonade now has $44 of our starting $100 and is responsible for paying 25% of each claim. If we run the numbers with a 72% loss ratio, which I think is conservative and will more likely be closer to 70 for the future, but with a 72% loss ratio, Lemonade is responsible for paying $18 in claims, while the reinsurers are responsible for $54. If we account for this and total everything up, Lemonade has a total of $25 of the original $100 in premium in gross profit, representing a gross margin of 25.75%, while the reinsurers have $2.25 in gross profit from this operation. We'll talk in a minute why Lemonade has chosen to do this, but they have said many times that they did not have to resubscribe for this insurance when they did this year and could have gone without it instead. Let's take a look at how this would have affected their economics if they had made that choice. In this scenario, every $100 of premium, Lemon keeps all of it and pays out $72 in claims. If we use the same conservative 72% gross loss ratio, this would leave Lemonade with $28 of gross premium, or a 28% gross profit margin. So we can see here that Lemonade is giving up 2.25% of the gross margin with this structure to reinsurers. Let's see why they chose to do this in the next few clips.
And that's really the fundamental or part of the fundamental reason we put this structure in place. It gives us protection if there's any volatility in loss ratio, and loss ratios can be volatile. The last piece, which is important to note, I think, is why are we doing all this? Well, one reason is to protect us when the loss ratio is volatile. The second reason, and probably a more compelling reason, is it reduces the amount of capital we have to set aside. So again, it's another way of making us a capital light business. That said, setting capital aside, which you can't use, generating a very low return, is something, if you can minimize that, that's a good thing for your business. You can free up capital to do other things, to drive higher returns, to drive growth, all the other things we're doing. In broad strokes, without this reinsurance structure that we have in place, we would be required, and we were required, to put aside about $1 in capital for every $3 in premium that we sold, every $3 in in-force premium, 1 to 3. After this reinstructure was put in place, that 1 to 3 ratio improved to 1 to 7. Now we have to put aside $1 of capital for every $7, roughly, of in-force premium.
There was a lot there, but let's break that down. The first reason that they put this reinsurance in place is to lessen the impact that the volatility of their loss ratio will have on the business. With the current structure, they only take 25% of the blow as their loss ratio moves around. The other reason they put this structure in place is to make them a more capital-light business, because they only have to reserve capital for 25% of the risk that they are insuring. This means that where they would have had to have $1 on the balance sheet for every $3 of written premium, they can now only have $1 in reserve for every $7 of written premium. This may not seem all that influential because they have $1.2 billion in cash as of the close of their last offering, and we're only at a $213 million premium run rate for the Q4. But towards the end of this 3-year agreement, they will continue to grow and start to run that cash balance down, and this will only help them grow faster as they need to keep less in reserves and can spend more on growing the business. For example, let's say they grow 76% next year in line with guidance, and then at the same rate for the next 2 years, which would mark the end of this current reinsurance agreement. By the way, I would not project these growth rates out past this year, and this is just for the sake of illustrating why this is valuable. As you can see, as they grow and their cash balance begins to dwindle, they will have to keep a higher and higher percentage in reserve, not spending to hire more engineers or customer service reps or advertising dollars for more customers. This is a good use of capital for the time being, but in 3 years, they will get another chance to decide if they want to take on the risk of their whole business or renegotiate another structure.
Seems like the loss ratio, according to my calculations, needs to be like 75% or less than, a little bit less than 75% for the reinsurers to break even. If it goes lower than 70%, then they're going to be able to make more, I guess, off of that $55, right?
Here, Dave clarifies that reinsurers only break even if the loss ratio is at 75%. Anything below 75%, they make more money. At least we can have confidence that will stay in those levels because the actuaries who are paid to evaluate the risk of Lemonade's business decided it will be profitable to reinsure their business with this agreement. In this next clip, Dave asked Tim about the unit economics of the customer acquisition and payback period. Let's listen.
We think really of the lifetime value. The payback period is important and something we kind of track, but we're really more focused on the lifetime value. What are we ultimately going to deliver? Because if your payback period is if your payback period is long, but the lifetime value is significant, that's a good trade-off. And vice versa, if the payback period is short, but the lifetime is not long, that's not necessarily a good bet. So we think it's important to look at both. We're paying a little bit less than $100 to acquire $200 of premium. So in your example, we're actually doing better than that. We're paying, the ratio is about 2.5 to 1. So for spending $100, we're getting about $250 of premium versus $200. So we're doing a little bit better than that currently. And then another thing that happens is it's pretty rare that someone's premium remains unchanged. So even a renter, for example, who's a new customer that stays with us for 3 years, even if they don't buy another policy type or they don't graduate to a homeowner, they typically pay more over time. They become wealthier, they need more coverage, their premium increases. And so that metric for us has been something like 50% increase over those 3 years without any other change. And so that shortens that payback period. If they graduate to a homeowner, that shortens the payback period dramatically. That's a small proportion of folks, but it's growing. And if they buy another policy type, so if they buy life or pet and hopefully additional things in the future, that shortens that payback period.
There are a couple of things here to look at. First, Tim really accentuated they are focused primarily on lifetime value and not so much on the payback period. And of course, this is the right move for their long-term business. He also mentioned that their LTV to CAC ratio is about 2.5 to 1, meaning they are spending $100 to acquire $250 worth of premium. This is a good ratio, I think, for a company that is still building out their whole offering, and I think this will only increase as we move further along. Tim also mentioned that the typical consumer pays more over time, citing about a 50% increase over 3 years, which works out to growing 14% a year, and this improves the payback period. This growth comes without any further customer acquisition costs to Lemonade, and will only accelerate in the next few years as they have more policies to add on. In this clip, Tim reveals just how fast Lemonade has been improving their ad spend efficiency.
And how we know we're doing well is that 2.5 kind of overall view. A year and a half ago, that was 1. And a year ago, it was 1 point something. And now it's 2.5. And so while that pace of improvement was pretty dramatic, it's probably, we don't assume that's going to replicate. It's hard to double that again. Each incremental improvement, that ratio gets a little bit tougher. 2.5 is good.
Going from a 1 to 1 LTV to CAC 1.5 years ago to now a 2.5 to 1 is really quite astonishing improvement. I'm sure a lot of this was driven by their relentless use of AI as well as their product expansion, and I'll expect this ratio to modestly improve going forward, but not too much, because if it gets too much higher, I would expect them to double down and advertise more in that area, which would increase growth rates but also decrease the optimal efficiency back into this acceptable range.
That change is as much an indication of the prior year inefficiency as it is the current year efficiency. So what that tells you is we were spending a lot of money at a ratio that was good for the time, but not nearly what we're doing this year. And so this year we're able to acquire significantly more business at fewer dollars per dollar acquired. So a significant improvement.
Tim responds by saying that this is as much an indicator of how poorly their ad spend was used a year ago and how much it has improved now. This is not an indicator that they are not investing in their business aggressively. It is more a sign of how they are attempting to run their business with the utmost precision and how they are succeeding in this. In this last clip, David asked about any long-term goals Lemonade has. Let's take a listen.
We can show those growth rates again and double again and double again and double again for a very long time because of the sheer size of this market. And that's really the ambition is add these additional product types, become a very large player, grow as fast as we can add healthy business.
The most interesting thing about what was just said was Tim's view that they can, quote, double and double and double again. And while I wish we could have gotten a grand long-term goal of IFP or customer count in 2030, it is still very encouraging to hear the CFO think that they have the capacity to double many times over in the coming years and still be a rather small player in the market. Thanks for watching. Let me know what your biggest takeaway was from this interview and what you think of Lemonade overall in the comments below. Also, let me know if you own any Lemonade or are buying more at these prices. Don't forget to like and subscribe. It really helps out the channel, especially because this video took significantly longer to make than most of my videos. My goal is to get to 1,000 subscribers by June 1, and I'd love to have you along for the ride. Thanks again for watching all the way through, and have a great rest of your day.